Buy, sell or rent your property with Century 21 and you could win a brand new 2-bedroom apartment on the Sunshine Coast in Queensland. Visit c21win.com.au for your chance to win.
Welcome back to Your Property Empire. Well, joining me on the show tonight is Rob Southwell, Managing Partner of Pitcher Partners Accountants and Advisors, and we've just been joined by Charles Tarbey, Chairman and Owner of Century 21 Australasia. Well, during the break, we had an email from Gary in Melbourne, and he asked, I've noticed that my yields have dropped from 4.5% years ago to around 3 to 4% now. I want to buy more property, given that there's talk of property continuing to rise in the short term, at least, but how low do yields have to go before you stop buying? So, Rob, I think probably a good start, being an accountant, is how do you calculate a yield, just in case we've got some first homeowners and some young people on?
It's pretty straight.
Got a bit of a visual on their screen as well.
Sure, it's pretty straightforward. You basically just take your weekly rent, times it by 52, and divide that by the value of your property. You can get technical and say, do you look at current yield or your actual yield, which is the cost that you bought the property for. So in this example, yeah, so if you were renting a property for $700 a week and it was worth $1 million, your effective yield is 3.64%, which is probably about the norm now, I would imagine.
Yeah, so it's certainly gone down. So Charles, you're into property management and you're seeing all the sales. Have yields actually gone down, or is actually people still paying the same yield, but effectively property prices are another few $100 grand higher?
Yeah, look, we're obviously been in a rising market for some time. It's going to impact on the yield all the way through. If you basically went off the yield, you'd probably sit still and say, I'm not going to buy anymore. But the reality of it is that at the end of the day, it's the value of the property if you're going to be borrowing, and your ability to repay if you're going to be borrowing, and the income that comes from that property if you're going to be borrowing. Those are the important factors if you're thinking about buying, selling, and the interest rates at that particular point in time. The yield, I've never really understood why we use it to a great degree, because in a stable market you get a good picture. But in the marketplace we've been in, it's really, really hard. Top end, as you know, the yields are ridiculously low because the value of rental compared to the asset is just almost insignificant in some cases.
And I guess it's the classic barbecue conversation, isn't it? That suddenly these experts, they say, oh, yields are too low, I'm not buying, but they don't necessarily understand the whole picture of things.
Well, it's why you always tell people you rent in the top end. Because the yield is so low in comparison. And I think that the important factor is, at the end of the day, your ability to repay, your ability to borrow, and just watching interest rates would be my reasoning for looking at property investment, not so much the yield. If it's just a basic residential, obviously some properties you need to do that. You need to find out what the cap value is going to be on properties when you're buying them. Those are important figures, although again that's another discussion, because the cap value, if there's a restaurant as a tenant, can be incredibly high, which is bad, and if it's a bank, can be incredibly low, which is good.
Yeah, so I think yield becomes a lot more relevant in commercial property.
Commercial property, yes.
And that's why you do get much more volatility with commercial property, whereas residential, it's more focused on the long-term capital growth, and yield is in sort of a secondary factor with that.
Because in reality, how much difference does it make? If yields have gone down from 4.5% to 3.5%, what does that actually really mean in real terms?
It's 1%. No. I think it's an interesting fact, though. If you look at the interest rates commensurate with the reduction in your yield, you're probably actually not too dissimilar than what you would have been 5 years ago when rates were, the official cash rates were up around 3 or 4%. So, don't look at your yield in isolation. If you're fully geared, you might find that the cash flow at the moment is probably very similar to what it would have been with a higher yield and much higher interest rate. So you've got to look at it in a
If somebody took a fixed loan 3 years ago for 5 years, nothing's changed for them.
No. Well,
changed. Other than the assets grown.
Yeah, exactly.
But nothing's really changed in their financial position.
Because again, 4.5 dropping to 3.5, it drops at 1%, which is, say, $10,000 or $200 a week on a $1 million property. But if you just suddenly made 100 grand capital growth, are you happy dropping 10 to make an extra 100?
Absolutely. I think also you've got to look at what's the total return on your property. Your return is the income that you're getting and the capital value. So if you're getting 3 or 4% yield, but you're still getting 10% growth, do you care?
I've never really known somebody to buy a residential investment based on yield.
Yeah.
I even understand with commercial industrial it's promoted that way, but if it's just a basic residential property there, people are just generally looking out for how much rent they can get, can they afford to repay, what's the interest rate. So on that count, it seems to be a completely moot point to a lot of investors.
Yeah.
Yep. Now, I guess...
Not to accountants. Sorry.
Well, really, you're just looking at saying, well, can I buy this property in the cheapest manner possible from a cash flow perspective? So if it's got a good yield, that helps you, but it's not the end.
Chris, these answers tonight are not mine. Chris sent me all of this stuff to read and say tonight because he wants me to reinforce some things for him.
Well, OK, so in your generation...
Yeah, oh, yes.
Yeah,
yes.
You remember the old days of investing. When you used to buy a property for 500 grand, you used to get about $500 a week, didn't you?
Well, yeah, you would...
Can you remember those days?
Yeah.
I mean, I only just remember them, but
well,
Charles would have remembered
I remember it when you'd buy a property for $25,000 and get $50
What were the yields in those days?
Get $50 a week rent.
Yeah.
Pretty good.
And you got 3p a week.
You two guys need to leave me alone. There is a car park outside.
Now, Rob, obviously people still need to cash flow their properties, don't they?
Yeah.
So do you think there's a certain point when yields do get down to such a low level that people can't afford to buy and they need to carry on moving?
Well, I think it's that if it does get to... It comes down to your personal circumstance. You can't afford to buy it. It's not so much the yield, it's your situation is probably the pertinent factor.
I think when both of you reach maturity, you'll understand it a lot more. That's what I think.
When we grow up.
I mean, you grow up.
Now, obviously we're talking about kind of cap rates and rental yields and capital growth and the rest of it. Is property investing a hobby thing that you just decide to go and buy another property, or really should you be treating it like a business and having the right kind of advisors around you?
Some people do treat it like a hobby, which is a little dangerous, and they do buy property off the plan. If somebody could sell them 5 and they could buy 5, they would, without really thinking about it. And I've seen that happen a lot. No, it's a serious business. It's a business that you should treat it exactly that way. That's what the capital gains tax argument was all about. What's the difference between an investment property being a business? You've got money in, money out, you're paying bills, you're paying people to do fixtures, fittings, clean things up. It's a business, and it should be treated with that sort of respect and watched very, very carefully, especially with people who buy a property, unfortunately, way out of town, way out of from where they live, and they don't get a chance to see their only investment property and drive past it, which I think is a very important issue as well.
And especially this time of year when everyone comes back from holidays and saw that holiday house, this is probably the time of year where I talk most of the clients out of buying that holiday house.
Yeah, they buy the holiday house, or they go on a supercar experience and they go and do all these funny things and just make emotional purchases.
Yeah.
Now, for more ideas on investing in property, you can always download a copy of my book for free. Just go to yourempire.com.au. And also, we'd love to get your questions. So if you've got a question, email your situation or strategy to chris@yourempire.com.au. Now, Charles, for the last few minutes of the show, we were talking to Tom earlier on. Obviously, there's lots of different markets around Australia and different things are going to happen. We haven't got the charts yet because, obviously, it's too early in the market. The auctions haven't started yet. How do you see 2017?
Well, I see it as a very different marketplace in most of the country. Some areas are still lacking a little in stock, and you're hearing about those. But I had the opportunity to get 6 of the top officers in Sydney into my office. So not 6 of the top, but 6 of the top performing agents who are principals as well. And they all were saying the same thing, and they varied from Lindfield across to Maroubra, over to Bonnyrigg, up to Kellyville, over to Maryland. So it really took in a very broad demographic. And each one of them said exactly the same thing. The amount of market opinions that they're being called into to value have increased significantly, not small, significantly. And a couple of them were reporting a substantial increase in stock levels. So it's really bizarre. So Tom will tell you he's booked out through the end of March. It still might be tight in his area, but that's a lot of auctions to be booked up to. So it's telling me that there is a change coming through the marketplace right now. And I do think that it is a change that we needed last year. I do hope it filters through.
Now, Rob, there's not a lot of talk about interest rate rising, but I've had a couple of letters from my bank that they're kind of pushing my mortgage rates up, even despite that.
Yep.
Do you see more of that coming? And should we, I guess, especially for the people that have bought in the last few years, should they be having some more cash buffer?
Yeah, I think the recent rise by the banks was the cheeky one. I think they saw that there was a trend that a lot of people were inquiring about fixed rates, and they saw it as an opportunity to get some better spreads. When you look at the 1, 2 and 3 year fixed rates, they're not that much materially higher than the current variable rates, which says to me that the banks think that the interest rates probably aren't going to do a whole lot in the next few years. The question is what happens beyond that.
The banks are changing things. So they've obviously allocated a bunch of suburbs in Sydney now that they won't lend more than 80% on.
Yeah.
So that's already started. So the trend is changing very, I think, nicely. I think long overdue.
So obviously keep an eye on it and have some of those risk factors to sort out to make sure you don't overextend. Charles Tarbey, good to see you as always.
Chris.
Rob Southwell, thanks for joining us as
Thanks,
well.
Chris.
Thanks for joining us at home. It's good to be back, and we'll be reporting over the next 52 weeks to see what's happening in the property market. Thanks for joining us. We'll be back again next week. Until then, I'm Chris Gray. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.